Thanks for joining us. After the fall that we saw yesterday, what's the outlook now? Do you think the pullback can further extend itself, and what are the levels to watch?
So we'll not rule out the pullback extending if we can hold maybe the support closer to around, say, 20,700, which is where the 20-day average is. So you may not see an immediate decline because seasonally sometimes the markets will attempt to go back higher into January. So that is something we'll watch out for. This view can change. It's also possible that we have put in the top. We can't be certain of it right away till we get some more additional evidence. The only thing that was clear, I think, was that we had gotten very, very overbought on, say, the RSI readings, which can give you a short-term knee-jerk reaction, which is what we've got. Now, at the same time, some very short-term indication based on our swing indicator will get very, very oversold also if the market continues to fall today. So we will start then looking for a bounce back. The question becomes, will the bounce have the strength to go back to a new high? I think we leave it open. We are not really taking a very specific view on it yet because this is the end of the year. You're going to go into holidays next week. But what I do think is that as we head into January of 2024, the downside risks will increase because of seasonal factors to the upside. So there should be this expectation that, we've pretty much run our course. We are in the late stages of this rally, and there can be a correction in the month ahead.
Okay. All right. Hi, Rohit. Good morning. Good to see you in. Rohit, the index that's come back in style in the last 1 month or so has been the Nifty Bank. And yesterday as well, that fell a little less than what the Nifty fell. What are the levels you're looking at on the Nifty Bank?
So on the upside, it's 48,000. On the downside, it's 46,500. And 48,000 is essentially the trend line of the last two major tops that were made by the Bank Nifty. And it was unable to get past that, except I think it closed above it for a day, but then it failed again. And so unless we really see a sustained move above it, we would, think that the Bank Nifty is losing momentum there, even though on a day basis, as you're mentioning, it may not have really pulled down that much.
Rohit, hi. Morning. Two questions. So one, the advice is to just sit tight, do nothing, right? Well, that's one. And second is you believe that apart from seasonality, and you're saying that in January usually 70% of the time is a down month, so seasonally it's weaker historically. There are some global factors which perhaps are important to note as well. So just briefly, Rohit, if you can take us through that.
Yeah, 7 out of 10 times January has seen a negative return over the last 10 years. So that is the main point. We often get a seasonal top in January. So if I have to take a bigger view of things, I'd rather wait it out. And why not even create some cash? So doing nothing is fine, but why not just sell something, create some cash, and have room to buy on the dip as and when it happens? So that would help. And on a trading point of view, there may be a short trade there somewhere. You just need to time it correctly. Now, having said that, there are three broad factors that I do think can play on the market's mind. One of them is China, because the China A50 index and the Shanghai Composite, both of them have been making 52-week lows recently. And whether that is going to result in some kind of an unknown event there needs to be watched out for, because when you break certain levels, it's a sign that something is going wrong. Nothing has come out of it yet, but that's something to be watchful of. The second factor that bothers me is, of course, the currency side, because the USD INR has pushed higher and higher. In other words, the rupee is now looking weaker among the emerging market pack in the short term. And the reason for that might have been, of course, FII outflows, because we are significantly dependent on that to fund our current account deficit. We have seen inflows in the month of December, which sort of stabilizes the situation for the time being. But that risk can very easily come back. I'm not, counting too much into this FII flow recently, because we saw the same thing in May and June, and then July, August, September again, we started to see outflows. So I don't really want to jump the gun here. We want to see how the new year starts before really, trying to say that FIs are back for good. So that's one risk factor on the currency side. The third one, which is much talked about and widely understood, is the yield curve inversion. And the recent Fed commentary, which was the driver of this rally in the end, will they really be cutting rates? I mean, they've just spoken about talking about cutting rates. There's really not been any action. The market is really pricing in the possibility. But the yield curve is still inverted, which continues to signal the potential for an economic slowdown. But on the other hand, you have data which says you have economic strength because GDP is growing at, higher than average. So what does the bond market do in the end? So the bond market is your third risk because bond yields, even though they may have come down, if growth numbers remain strong, can go up all over again. And unless I really see the Fed doing QE, I don't think you can really get bond yields into check without a significant slowdown. So that is the third risk.
Okay, all right, Rohit, we'll leave it at that. Thanks a lot for joining in and giving us a perspective on the market, which, by the way, there's less than a minute for the market to open. So let's just, get our focus on that.